guest is one that was just spotlighted in Toronto Life magazine. His name is Sasha Cucuz, and he is the CEO of Greybrook Securities and a partner with Greybrook Capital, one of the largest private equity firms in the country. As the CEO of Greybrook Securities, Sasha is responsible for the firm's operation and investment strategy, and together with his partners, Sasha has played a significant role in growing Greybrook's investment portfolio to include over 80 multifamily and investment projects throughout North America, which represents over $17 billion in estimated completion value, including over 23,000 residential units currently under development in Ontario. I'm very excited to share the wealth of knowledge that he's going to bring to us today. Sasha, thank you so much for being here. How are you doing today?
Thanks for having me. I'm doing well, thank you. The weather is beautiful. It's summer. Can't complain.
Yeah, for sure. So Sasha, you guys are one of the largest private equity firms in the country. But for those who don't know Greybrook, can you go into how this company got started and what exactly it is that you guys do?
Sure. So we're one of the largest, as you said, in real estate private equity specifically. And our focus has been over the course of 17 years that the firm has been active, primarily in residential development-based investing, and we're equity investors exclusively. So we're not part of the debt stack in any transactions. We're always the equity. When we started the business back in 2004, my partners and I kind of thought that a unique way to generate great returns would be to look at development in real estate rather than how traditionally real estate was done by institutional investors, which was more buying existing assets and looking at their appreciation potential over time while kind of collecting cash flow. We thought the development represented kind of a unique value creation activity, buying the land, taking it through a process of entitlement in some cases. And then obviously, we think of ourselves as manufacturers of real estate more than anything else. To do this effectively, we made a decision very early on in our history not to be developers ourselves, but rather to find best-in-class developers and partner with them. And that's how we started the model. One of our first partners was a developer called Plaza Corp. We've since worked with many of the largest developers in the city and expanded that over time to outside of just the GTA, where we focus on all different types of housing, whether it be rental or for sale, condominiums, high-rise, mid-rise, low-rise, and everything else, master plan communities. And now we're doing it throughout various cities in North America. So we have a very specific thesis on what we look for in markets. And obviously the GTA is one of those markets that has these characteristics. And we've since looked beyond that to do this in South Florida quite actively, as well as in cities like Atlanta, Denver, and other parts of the US.
Well, that's very interesting. So what are some of the factors that you think makes a good investment?
Well, I think certainly on the residential side, we look for really a number of different things, but one of the most primary things that we look for is a factor of scarcity. And the way I define scarcity is looking at both sides of the supply-demand equation and making sure that there's an imbalance that would support price growth in housing. And if you look at the GTA specifically, it characterizes these things where we have in the GTA a situation where population is growing, whether that be through migration into the city or immigration from other countries where people decide to come to Canada. And obviously Toronto is one of the cities that has a lot to offer. It has a very diverse employment base, a lot of different things for people to do that brings people to the city. So as a result of that, the demand side of the equation represents a lot of growth. That's not enough, though. You need to have also certain conditions on the supply side that make it such that scarcity exists. So what we mean by that is to say, if we could manufacture housing, I use the word manufacture, developers produce housing. If we could produce housing as an industry that was sufficient or greater than the number of people that need it, then we wouldn't have the type of stability and price growth that we see. On the other hand, we have certain conditions in this market, whether it be through legislation, process, infrastructure limitations, whatever those factors may be, make it such that the production of housing is simply insufficient to keep up with that demand. And that is what drives the stability and price growth that we see in this market. And that's more or less, among other factors, what we like to focus on first and foremost when we're choosing our markets.
Right. So you said that you guys are pretty much partners with the developers. What exactly does that mean?
Yeah, so we're a very active participant in development. So unlike some investors who invest alongside an execution partner and take a more supervisory role or sort of a role where they're being reported to on a regular basis, we like to think that we add value to our development. So part of our value proposition to developers when we're looking for partnerships and deals to do is to say that, yes, we bring money to the equation that I think can help everybody scale. But in addition to that, we bring a lot of expertise. The firm today consists of around 85 people, and more than half of our team is allocated specifically to the development and asset management side, as we call it, which is working very, very, very closely with our developer partners throughout the course of a development. So from the time we're seeing a property, whether it's the underwriting of that property or after acquisition, the management of that development program, we're there to help our developer partners and really add a dimension to the overall team.
Right. So I don't know if you know a little bit about me, but I'm pretty much a pre-construction agent. We're doing about 400 deals a year, and all we do all day is source opportunities in developments for our clients. So I kind of wanted to get an insight into how do you go about sourcing opportunities and deciding who to partner up with, which projects to be involved with, and so forth.
Yeah, so I'll answer that question the following way. I think the way that we do it today is very different than the way that we did it, 17 years ago. Today, we have a number of established partnerships that we've worked with for many, many years and had many successful outcomes. And our teams have been able to integrate, and we have a very set way that we do things together. So it's a very smooth and natural process. And a lot of times, it's not us that are out there sourcing properties. Most top tier developers in the city are built to be able to find and assemble, in some cases, properties to develop. And ultimately, our partners are the ones out there predominantly that are looking at these properties. And then when they find ones that are suitable for the business model that we have together, they'll often bring us into these deals. So today, the way we source those opportunities is more a function of our network and all of the people that we've worked with. And then, of course, in auction scenarios or scenarios where there's a process to bid on property, we've done enough deals and we're notable enough in the industry that typically we get a phone call in and amongst the first people to get phone calls on property. So that's kind of how we execute our acquisitions and sourcing today. 17 years ago was a little bit different. Obviously not having the history and track record and sort of network that we have today, really we relied on trying to find one or two good developers and sort of convince them that this model worked, because the benefit is twofold. It's not only a benefit to investors where they get access to large scale properties that they can participate in as owners, as equity owners, but also to the developer, because it gives them the capability of being able to better leverage their own resources and capital to be able to do more and scale quicker. So in the early days, it was really a function of meeting the right people and doing a few different deals with them and really proving that we could bring to bear that which we said. And then, it's a very small world. As big as Toronto is a city, at the sort of top end of real estate development, everybody knows everybody. And once, we were able to perform for a partner, it gave us a lead into another relationship and then from there another one. And that's kind of how it evolves over time. So deal sourcing at the beginning was a lot more active for us. And today, I'm not going to say it's reactive, but in many cases, we're supporting the partnerships that exist.
So you're currently involved in about 80 projects, is that correct?
Yeah, I think we're over 90 now. We've had a really active year in 2020. one so far. So we have about 90 developments in aggregate, and that includes as well a business that we are partnered with a developer called Marlin Spring on exclusively. That is a value add strategy. So that's more buying apartment buildings. Yeah, so that's something that we do, and within our total portfolio, we have about 90 projects and a little over $20 billion worth of development underway now.
That's amazing. And primarily, are you more focused in the GTA? But you said you were also expanded into North America, right?
Yeah, this year was about 50-50. I'd say that the GTA is our primary focus and will continue to be. And frankly, when I'm asked this question in the US, sometimes when I do different, speaking engagements, people ask about Toronto, and it was never a function of living here. And that's something that I can't stress enough. Like, as a private equity firm, capital is mobile, right? You can do diligence on markets and implement your strategy in many places. Our choice to be in the GTA was very much a function of the specific conditions that exist in the GTA around supply and demand and that imbalance that exists and sort of what the sustainable growth factors are for this market. So I don't see that changing anytime soon. So for your clients in what you do, I think there's a very, very robust market ahead of us over the next decade plus, because the growth trends will continue here in the city of Toronto. And sort of, when I say the city of Toronto, it's not just Toronto. It's sort of, I've encapsulated in my thinking, even Southern Ontario, right? Like, you're looking at a node within the country that carries almost a third of our population and is continuing to grow disproportionately to the rest of the country for all of the reasons that we know, right? Job opportunities, the type of, knowledge economy that exists here and things of that nature. So I don't see that changing anytime soon. And very specifically on the supply side, as I'm sure many of your clients will know, in pre-construction, one of the toughest things is, the production of housing. And often, it's very regulated. It has a lot of community interaction, and all those things are very good because it helps us preserve the integrity of the city and all the things we love as citizens. But at the same time, it does represent a bottleneck in massive amounts of supply, and that's why these conditions exist. So, I think the GTA and our focus on the GTA is something that will continue.
Yeah, like the approvals process, for example, is very slow in Toronto compared to like other major cities, right?
Yeah, so we operate, as you pointed out, in other markets. So I recall back in 2014 when we did our first development project in Miami, my partner Peter and I flew down to Miami to speak with our team of consultants and our partner Property Markets Group. And one of the things that when we had the planning lawyers come in and kind of walk us through what the planning process would look like in the timeline, the first thing that went through my mind was like, that can't be right. You defined a 3 to 6 month time frame for approvals from acquisition, and that's something that we haven't seen in Toronto since 2004. And I think that as cities grow and intensify, there is a lot of complexity to them, and a lot of times that can't be avoided. Sure, there's some bureaucracy and things that can maybe be cut out of the process to make it a little more efficient. But by the same token, when you have more construction than anywhere else in the world, that has to be taken into account and properly regulated. So it is much easier in many other markets that we operate in. But at the same time, I like to think that this is one of the things that make Toronto such a livable city at the end of the day.
Yes, for sure. So, Sasha, I wanted to ask you, what is the actual process for someone to get involved with Greybrook? So with pre-construction, the project comes out, we're under the planning stage, they do installments and increments over the next 2 years. What's the actual process with a product like yours, which is a little bit different in terms of how it's structured?
Sure, it is a little bit different. We're often involved, well, not often, in every case we're involved much earlier, right? So for a typical investor of ours who would like to get exposure to, as I put it, the manufacturing of real estate. So it's a little less market dependent. And this is why I believe these strategies to be complementary, right? If you think about a pre-construction buyer and what they are ultimately gaining from buying something in pre-construction, it's very different than, what our investors gain investing in the actual development, because we're sort of a margin-based business, whereas the return is a margin-based return, whereas in pre-construction, it's the health of the market and long-term sort of capital appreciation. And I think they're both needed. So for us, people get involved very early. We have at this point, we have about 7,000 investors in 32 countries who invest with us. And once they're a part of our network, we like to show them, the things we do. And if it's of interest to them, they participate. And we have an entire team that's dedicated to helping people, understand how to build a proper portfolio, because it's not just about buying a project just because you like the street corner. There's a lot of detail that goes into this stuff. And for people who are looking to build this type of exposure, we often try to guide them to taking a more portfolio approach to things and buying smaller pieces of more projects to have an appropriate amount of diversification. So we help people achieve that. The other benefit to people who are typically pre-construction buyers, and how it's complementary, is the fact that you can use your registered accounts. So people can use RSPs, TFSAs, RIFs, RESPs, all of these vehicles that are typically not available to you if you're buying hard real estate. So it's a way to kind of get to participate in the market, both passively through your retirement savings, as well as actively buying in pre-construction.
So what you must be seeing is that people who've rolled in their RSPs into this, they probably want to invest in another project after that. They probably don't even want to pull that out, right?
Yeah, that happens. I mean, listen, we want to do a good job for people. And our philosophy is that if we've done a good job, then people will likely want to reinvest with us. And if we haven't, then we probably don't deserve it. So the way we think about it is, when people get involved with us, oftentimes it's we make it flexible. So, traditionally this type of investing requires a lot of capital, right? In our case, we break it down into bite sizes. So somebody can participate with as little as a $25,000 investment. But ultimately, if we do well, then hopefully they'll decide to do more. And that's kind of how we've always viewed the world.
So that's really good. People can get in with 25K?
Yeah, so there are certain criteria that people need to meet from a securities law perspective. Like, we're regulated by the Ontario Securities Commission, actually every securities commission in Canada, as well as the SEC in the US. So there are certain rules, but they're generally not big barriers. Most people who can participate in, let's say, pre-construction condominiums oftentimes can meet some of the criteria to invest in our projects. And then we just made the bar quite low. Frankly, $25,000 is really a number that most people can afford, and we try to make it accessible.
Yeah. So let's say somebody has $100,000 to invest. Does it all go towards like one project, or does it go towards your portfolio in general, or how exactly does that work?
Yeah, so that's a great question. It's not a fund. So if you and I were sitting together and you said, look, I have $100,000 that I want to invest in this strategy, the first part of the process is you and I would get to know one another, in the sense that I would really need to understand what you're looking for out of this $100,000. Timing, liquidity, different risk tolerances, and things like that. Once I had a good understanding of what that looked like, my recommendation would always be to take that $100,000 and break it up into 3 or 4 different projects. It's, of course, always your choice, right? So, for example, we always encounter the type of circumstance where, we're buying a master plan community, let's say in Cambridge, and we have an investor from Cambridge that really knows Cambridge and really believes in it, and they like to invest, take all their exposure in Cambridge. We often advise that it's not a great strategy to put all your eggs in one basket, but at the end of the day, it's your choice. Our recommendation is always to take that $100,000 and over the course of a year, we may do 7 or 8 different projects. So depending on what you're looking for, what your timelines and risk tolerances look like, we'd be able to match that and give you exposure to different, a good example would be across 4 or 5 different projects. You can get some high rise, some low rise, some in Toronto proper, some in the peripheral of the GTA, and maybe exposure in a place like Atlanta, where you otherwise wouldn't have any real estate exposure. So, we try to create portfolios and strategies that make sense for the individual.
And like based on your past projects, what kind of returns are we looking at approximately? I know it's different for every development, but
Sure.
where can you guide us?
Yeah. So our target, generally speaking, for a typical housing development, whether it's condo, or low rise, is going to be about a 20% net annualized return. So if you think about the type of investing this is, it's in private equity, unlike other real estate strategies where you can expect cash flow on an annual basis, you're buying a piece of dirt and then you're manufacturing a building. And at the point when that building's completed is typically when we realize our profit, whether that's a building or a housing development or whatever the case may be. Now, of course, there's variation to that depending, sometimes when you're building 1,000 homes, you're closing on 100 of them and another 100 and another 100. So sometimes cash can come out of them quicker. But generally speaking, we would expect, or an investor would expect over a 5-year time frame to double their money. And so it averages out to about a 20% net annualized return. But at the same time, from a cash flow perspective, it's like money in on day one, money out at the end. And that's typically the expectation. Yeah, I mean, like historically, we've done better than that on average. But the reason that we preach diversification is frankly, sometimes you're going to have projects that do extremely well. Like there's been projects even this year where when we underwrote them, what we expected to be able to sell a home for versus what we actually sold the home for were two very different numbers that benefited the project and the return profile greatly. And that'll happen from time to time. But then, again, from time to time, you'll have markets like 2018 and after the Fair Housing Plan where things didn't go as planned. So we target that 20%. Sometimes we do better. Sometimes we do not as well. Obviously, we try to limit those, in number. But that's why we tell people to take a much more, broad and diversified approach, because on average, you're going to end up in a good spot.
Yeah. So what are some of the projects that you're currently working on that you're excited about?
Yeah, we have a lot of them. I mean, I think if I could highlight a couple that are exciting for me, one, I'll highlight one in the U.S., which is we're building a Waldorf Astoria hotel and residence in Miami. It was the largest, it is the tallest residential building south of Manhattan. And it'll really be unique and redefining of Miami's skyline. And
that the one that your hand or someone is part of? Who's selling that building? I think it's one of the $1 million listings.
Yeah, it's Frederick Eklund. Yeah.
Oh, okay.
So it's Frederick Eklund that's selling the building, and so that's a super exciting building. We launched it a few months ago, and we've done extremely well in sales. It's a very iconic building that we're building there. So that's one that I can highlight that's obviously pretty exciting. Here in Toronto, if I were to take a reciprocal sort of a high profile type project, we're redeveloping the corner of Avenue Road in Yorkville together with First Capital, who's our partner there, and BMO, the bank. And the three of us are basically redeveloping the corner that is based beside the Hazelton Hotel, more or less. And we've owned that for a number of years and are now getting to the point where we're ready, or will soon be ready to launch sales. And it's a very unique and exciting project because, it's in our view, we hope to be redefining luxury in the city with that corner. So look, those are two sort of high profile, sexy, luxurious type things, but we build housing communities in places like Shelburne and Colgan. And I bet you don't even know where Colgan is, because I didn't know where Colgan was.
I don't know where it is. Where is that?
It's actually west of Tottenham, north of Caledon. So it's kind of, it's today you would consider that place, it's funny because we just bought a parcel in Lindsay, Ontario, or in the process of buying it with Tribute Communities. And a lot of times, 10 years ago, I wouldn't have thought Lindsay would be anywhere I'd be interested in building new homes as a primary housing development, not vacation properties and things like that. But as the city has, and you would know this obviously in your business, as the city's become more expensive, people have started to look at their alternatives, and their alternatives, used to mean Mississauga and Milton and Oakville, but those are getting expensive too. So people are going even further out than that. And now that transit accessibility is improving and highway infrastructure is improving, and not every job is in downtown Toronto, right? So people work in the peripheral, they work in Markham, they work in these different places. So to get from Lindsay to Markham is like 40 minutes of a commute, and there's probably not a lot of traffic. People are making the choice because it's a lot less expensive to buy, a 35 or 40 foot home there than it would be anywhere in the GTA. So for those reasons, the Colgans and the Shelburnes, they might not have the sex appeal of a 138 Yorkville or a Waldorf, but at the same time, we've always said, and we pride ourselves on the fact that we invest in all types of housing for all types of individuals. It's not just the ultra luxe stuff. It's not just the rental stuff. It's for everybody in between.
And I'm very curious to hear about why Atlanta, because earlier on you mentioned Atlanta.
Yeah.
What did you see there specifically?
Yeah, so Atlanta has a very unique environment at the moment where the city is about the same size in population to Toronto. So there's about 6.5 million people in Atlanta. It's considered more or less a gateway city in the U.S. So it has a large airport, which is obviously, connects a lot of the United States. So a lot of head offices like to be in Atlanta because they're executives and others who have to travel. It's very easy to get anywhere in the country. So what's happened over the last 5 or 10 years, as the knowledge economy has continued to grow and prosper, a lot of the types of businesses that we like to see in certain markets are showing up in Atlanta. The Microsofts, the Googles, the Airbnbs, businesses like that have, I think, that draw a lot of sort of young, upwardly mobile professionals into the core. So we managed to secure a property there that is right in the Midtown Atlanta area, which is kind of the really hot area of Atlanta. We bought it at a great price. And the fact is, we've been looking in that market for about 3 or 4 years because our execution partner in the U.S. Property Markets Group, PMG, their principal went to Emory University, so spent 4 years plus his postgrad in Atlanta, really got to understand the market and the area. And he, for a decade, has been pushing us to really take a look. So 4 or 5 years ago, we started to get to know the market. And oftentimes, we're not keen on investing in something that's brand new. So we take our time and try to understand the market at a very detailed level before we buy something. So Atlanta is a market that we've been looking at for a number of years, and the stars aligned and we were able to buy a property in the right area. And it was very specific. It's a very specific type of thing that we do in these cities in the US, which is build multifamily or rental apartment buildings that are very, very unique. So if you or your clients or listeners want to take a look, it's called Society Living is the platform. You can take a look at the Instagram handle or any of our social media, but it's a combination of co-living as well as social living in a very technology-enabled, amenity-rich format. So it's kind of the opposite of what you would typically see in a place like Toronto, in terms of your typical maximizing leasable space and not having the type of amenity profile. In certain markets like Atlanta, Miami, Denver, where you have a little more liberty in your zoning parameters, you're able to allocate more to your amenities without impacting your leasable square footage too much. So as a result of that, we're able to build some really, really spectacular buildings that are drawing a lot of interest from young people. And so far we have 2 of them that are built and fully leased, one in Miami, one in Fort Lauderdale. And they're extremely, extremely popular. And we're achieving rents that are at a premium to the rest of the market.
Wow, that's very, very interesting. So you guys are expanding pretty much everywhere in North America. Sounds great.
We're trying to. So as the firm, grew, it's funny because you think back, at one point it was, 3 or 4 or 5 people. And today having over 80 people, it's quite good. I mean, we're only as good as our people. And frankly, we have an incredibly talented team here that we're really proud of, and they do a really fantastic job. And that's enabled us to take advantage of opportunities as they've come up.
I think what excites some of my clients so much when I was, corresponding with them about Greybrook was the fact that they can use those RRSPs and the RESPs and so forth. I know you generally oversubscribe for your projects, but you'll be able to help us out, right, going forward?
Yeah, for sure. I mean, we always want to take a long-term approach with our clients, and part of that is, a lot of times, if people haven't heard of us before, they hear about us as part of an offering, right? So when something's in the market, either a friend tells them or they hear about it and they're like, I want to invest in this deal. And maybe that's possible. And we try to accommodate whenever we can, because we like to, start new relationships with investors. But at the same time, we try to coach people to taking a patient approach, because it's not necessarily about a specific deal. Although I get this question all the time, which are people like, do you like this deal better or this deal better? Well, frankly, if you're seeing it, it means I like them both equally, because it's gone through a pretty extensive process to get to the market where, from the time of our underwriting, it goes through an investment committee. There's several layers of diligence and decision-making once something gets to market. So whether it's a housing development in Colgan or whether it's at the Waldorf Astoria, sometimes people gravitate to the sexier ones, but oftentimes in a margin business, you can make the same amount of margin building, housing in areas where it's $800,000 to buy a home as the type of margin you can make when you're selling a condo unit for $5 or $6 million, right? So frankly, that's how we try to approach it with people. And in every case, we'll make accommodations for new investors. It's part of our strategy is to make sure that we're always expanding and giving people access.
Yeah, and it's so great that they can get in with a relatively low amount of money, right? So it's a great opportunity for people who can get into even pre-con, because with pre-con, sometimes you need about 150,000 at least. So this is
for sure. I think for those reasons, it's complementary in a lot of ways, right? It's complementary exposure. Plus, you can use money that really isn't available to you or inaccessible in the case of pre-construction.
100%. Sasha, thank you so much for the wealth of knowledge that you've provided us today. It's been great speaking with you. We've learned so much from being here. We look forward to doing business with you hopefully soon in the future.
Absolutely. Thank you so much for having me.